Good morning. Can you hear me? Can you see me? Good morning. Good morning. Perfect. Okay. I think we shall wait for another 5-10 people. While we are waiting, actually, I will start a very short poll, which will help me a little bit. Please kindly answer just 3 easy questions. Let's wait maybe 3-4 minutes, other people, and we'll start. Others will join on the way. I see most of you have started reading, have read already the presentations, but it's harder with the books, right? If you can tell me why, I don't know, maybe you need direct links or have some problems with SAE library. How it's easy for you?
I'm sorry, can I ask a question?
Perfectly, sure.
Yeah, where we can find the list of this book, because
It's in the presentation on the first one.
okay.
There was a required list and recommended list, and I tried to make it easier. Just I checked whether you have the books in the library, and I put only those which you have there.
Okay, thank you.
Okay. I think we can gradually start. Those who join in, yes, please kindly answer the poll. It will help me maybe to, I don't know, to know where we are on our way. Maybe we have become faster still somewhere. Okay, I will not be closing the poll. Let's continue. So today we have week 4. I'm sorry, week 3. And we have already covered the VC basics. We covered like the GP-LP partnership or VC fund structure, and even analyzed returns of venture capital investments. Later on, I will forward you maybe a couple of papers from Preqin or PitchBook, the latest up to date. If it will be able to get them free of charge, they making less and less of those freely available some way. Today we should cover the venture capital fund investment process, to some degree the portfolio management, and also the basics of startup and role of the founder in these topics. And in the following 2 lectures, the 4th and the 5th one, we will cover actually the most comprehensive part of our course. It's the venture capital deal, structure itself, different terms, term sheet, and also the problem of valuation. However, today we will touch this valuation idea, and this is our plan for today. I will tell you a little bit about the sources of capital for startups. We will compare angel investment, venture capital investments, and buyout investments, which are private equity, as far as you remember. Investment process of the VC fund will be covered in generally, but you will get more information from books and white papers I will send you this weekend. Basics of the startup, something we should cover today for sure. It's the capitalization table thing and the idea of pre-money and post-money valuation, the concept of that, just very shortly. And we will touch on that later on in the valuation topic. If we able to cover all of those, we'll try to cover entrepreneur's role. The interesting thing about the founder's dilemma, it's when the founder have to decide which way to go. So like the point of bifurcation, mostly psychological. And maybe I will be able even to show you some numbers in the slides. So let's move on to the first one. It's sources of capital for startups. Yes, I think I see people are joining gradually. Those who join, please kindly don't forget to answer the 3 easy questions. I have the poll still opened. I will be reminding that on a regular basis. So, as far as I already know, investors usually invest across the so-called the S curve, right? So the earlier the stage of the business, like the earlier the types of investor types. So at the first point, we will have maybe angel investors, but even they are not the first one who invest. Then later on, venture capital investors will join somewhere when the S curve goes up. It's when you have growth, you have product accepted at least partially by the market, you have revenues, and you need to scale closer to the bigger business. Already the valuation of today it's several billions mostly. It's where private equity growth investors and private equity investors come into play with big tickets and big funds, and then the company becomes mature. Somewhere in the growth stage, usually you want to make an exit, either a venture capital fund or growth fund. And when the company mature, it tries to make R&D, some changes in its lines of business. If it was a successful startup, usually it's a public company already. Okay, let's talk about some sources of capital for startups. I put a lot of sources here, just for you to get the flavor where, in general, founders can get money for their initiatives. Of course, IPO and private equity investors, it's already the latest stage of the idea. On the idea stage, you maybe will have some personal savings. People will use their credit cards. Maybe they will have second mortgage, or they will pledge their home. They will ask money from friends and family and fools, of course. especially in those who don't understand a lot in finance. There are, of course, government grants, and even in Russia, we have some vehicles which actually provide grants. It might be an asset-backed loan if the business model allows you to do that. Accounts receivable factoring. So a lot of other types of investment sources of capital are available. So if we try to get the most interesting for us, actually, it's usually friends and family, the early stage, some type of crowdfunding. And if we look at more institutional types of sources of capital, it's usually already angel investors, which already put together with VC funds start choosing companies and projects on accelerators demo days. It's when the accelerator is making a full day of presentations, short presentations of startups, and angels and VC funds, usually early stage, they try to pick those they like. And there's interesting type of investors. It's corporate strategic investors. They usually invest in the lines of business which actually can disrupt the existing business. So the most obvious example today is maybe like companies like automakers like Hyundai and BMW, Mercedes, trying to invest in companies which actually either help to, first of all, it's electric vehicles. Of course, everybody wants to catch on that train. Don't miss that one. And anything which actually helps driver navigate the road. And maybe also one of the lines of business is trying to make a driverless car. Who knows? We'll see how it will play. And let's move on. So now let's move on to angel investors, actually, and we have to know who they are. It's usually accredited individuals, and they invest in early stage. It's seed or early stage companies, and usually they come when those FFF, or source of capital, which is friends, family, and fools, has already been exhausted. So actually, you use your credit cards, all your relatives has already provided you loans, and you still need money. But maybe you have a good idea. So angel investor will invest in good idea. It's usually the first outside investor in the company, even before the company is organized legally and structure-wise, I don't know, HR-wise, and etc. So usually it's the idea and just some starting efforts of the first team. Usually the size of investments here is relatively small. Usually, but in the latest couple, maybe 2-3 years, all valuations and deal sizes went up. So actually today angel investors might invest like maybe millions of dollars in early stage ideas. Let's move on to venture capitalists. That's actually venture funds. They seek to identify companies that have great business opportunities in their terms. And here is financial support is needed. Some managerial support is needed, maybe some help with finding the right people and put them into the right positions, providing them the right mandates inside the company, and also strategic support. Here, experience of well-branded names come into play. Usually, early businessmen, they want somebody who is experienced, or at least perceived to be very experienced and successful. Venture capitalists invest alongside company managers for sure, and usually on this stage, option pool is being provided. So option pool is just in shortly, it's motivation for the management team, right? To keep going, working a lot, extra hours, in a hope that their stake in the company, which they will get through options, will worth a lot. Here, venture capitalists actually, when they make a deal, they want to be presented in the board of the company already, a board of directors, and they want to monitor the situation, at least observer rights, but sometimes they want voting rights already. we have to know about the corporate venture capital. That's called CVC. It's not something we will be covering a lot in our course, but for you just to know, besides the regular venture capital, which usually goes from VC funds, VC managers, there is also corporate ventures, and they're becoming more and more popular because the pace of transformation in many industries is extremely becoming extremely faster, and companies want to be, let's say, more agile, more flexible. They need to find ideas given the standard structure of the company. It's very difficult even for good companies to make new I would say great ideas inside the business. Usually most of the team managers, they following the business as is. They're trying to adjust slightly, but it's difficult for them to make a leapfrog, right? They're trying to do R&D. Some companies are extremely, I would say, successful in that, but sooner or later they will come across some problems. And one of the caveats here is just try to invest in other startups using your corporate money. And they make corporate CVC arms, which actually becomes another types of investors into the startups. But usually here, corporate CVC, usually they invest not because they want to get high multiples on IRRs. Sometimes that's true. But one of the motivations, and usually the biggest one, is actually to catch this nice idea, get some information about new technology, and in best case just incorporate this new type of company into the company. So actually the company doing these things might become like another company, right? More, I would say, forward looking. And usually, yeah, they are unavailable to the public, to family offices, to institutional investors. It's just the money of big companies who decided to pursue new opportunities, new lines of business. A little bit more about angel investor. He's actually he should be wealthy. He's or her own cash invest in early stage companies. They usually very selective, maybe 1-3%. That's general numbers, but that's, of course, that's clear, right? We have a lot of information coming in, and just a small piece of that worth our attention, and even less investing money. They're usually true initial investors in great deals, and of course, venture capital funds, they're happy to see brand name angel investors in startups. That's one of the tick box they will be noting for them. If we go back into the history, maybe a century ago, angel investors actually provided capital to launch new theatrical productions on, as far as I remember, on the Broadway. So to be honest, it was an interesting idea. They actually funded this idea of entertainment, and then made a healthy amount of money. That was a good business. That's one of the history years. I haven't lived those times, unfortunately. Today, actually, during a round of investments in a seed or startup, angel investors typically will invest 100,000 each. When we say each, remember, we mean that angel investors, as venture investors, will put money together, usually, so to diverse their risk. So on an aggregate basis, something below 1 million invested into the company would be normal in this case, as a round. Yeah, so usually it will be 250, 1 million. The company valuation will run up from 1 million to 5 million. As far as you remember, this first critical gap between friends and family finance and venture capital finance will be met, because the company, great startup, needs that money before it becomes slightly, or not slightly, bigger, more promising, with some traction. Just remember, when you venture fund, you have limited resources, and some small deals will be just under your radar. right? Because it's not worth investing in them. You need to invest. Remember, rule of thumb, in something which will pay back you the whole fund in general. So collectively, formal and informal groups, angel investors will purchase stakes from maybe 10, 20 to sometimes half of the company equity stake. They will be trying to get a return of 20, 30x over 5 years, and sometimes slightly more. But that is reasonable, right? Because they invest really early stage. The statistics is usually against them, but they experience help them. Not all of them, but only the best. And as far as I remember, on each stage of investments, your stake should be diluted. I will show you today a nice picture. But the idea is when you invested in early stage and then you have several rounds of investments, your stake in the company will be decreasing every time. So if you're starting with 20, 30% equity stake, you might be ending up with, I don't know, several percent later on. The company will be bigger, the valuation will be much higher, but your stake will be, of course, lower. So it's all about this game, multiplying two things, valuation of the total company and your percentage stake in that. It's important to understand that, first of all, angel investors, they are like much easier in terms of dealing with them. If you're in an entrepreneur or you start up, it's easy for you to get money from angel investor rather than from venture capital. Now, they less constrained, they require less documents and paperwork and all that stuff. Interesting enough, angel investors don't want or require control or board seat. They are fine with the idea. They're just slightly more emotional in this term if we put them together. And as far as I remember, VC funds, the venture investments, they usually manage other people's funds, other people's money, while angel investors actually invest usually their own money. So here you have this difference as well. And it's more important for angel investors, this personal chemistry with the founder and with the idea. They pursue their values and etc. They want to somehow also give back to the industry. Financial return is important for them, but not always. Sometimes they have this other type of motivation. And many angel investors actually in the past are successful entrepreneurs. They made exit. They some of those entrepreneurs become senior entrepreneurs, but some actually just become a part of the ecosystem, which help them. And they keep investing into the industry and other ideas and other entrepreneurs. Interestingly enough, angel investors actually rarely competes with venture funds for same deals. There is some overlap on the early stage types of deals when angel investors are ready to put big money, big ticket, and the small VC fund wants to find the seed early stage investments. But that's not a big problem. At least I haven't read a lot about that. Angel investor also is somebody who will provide the first piece of a really great experience and maybe help avoid the typical stupid mistakes. They will help management teams to make needed adjustments and also will help to prepare for next financing, which should come from venture funds, right? Angels better understand how it works. And they have industry network. They also can help not only with technical things in preparation for that, but actually they can get the source of money itself, right? So they might, I don't know, get some VC funds into the negotiation on the next round. They can also help to find good employees and etc. So if we think about the IRR terms, they would seek 25, 40 IRR on invested capital. All those numbers, the earlier stage, the less scientific it is. It's just from different sources of information. But the idea is that usually you want, the idea here is usually the same, right? You want to get not to pay off the whole fund. Angels don't have fund themselves, right? However, they start appearing, professional angels fund. But the idea is they want from time to time get the return on particular investment, which actually covers many dozens of other investments into their pipeline. So logic is the same. The risk are higher. The risk is higher. So actually, the expected return should be higher than in venture deals. Now let's look at the differences between angel and venture capital financing. Maybe it's slightly small, but anyway, you will get it. So first of all, the tickets, right? Angel investors will invest from, I don't know, 25K to million and a half. The venture capital usually will invest from millions and up. Sometimes it might be smaller. So here, at least 500,000, but usually much more. If we talk about motivation to invest, just remember emotional drive, coaching, ability to coach, involvement into the idea, something which is very interesting for angels. VC funds usually seek for returns, more money motivated people. If we talk about access, actually, angel investors are not that easily to be found, right? Usually they are found through referrals, so it's like the radio of mouth. It's the anonymity. You usually cannot write them if you don't know exact email or phone number. Then VC funds are more visible investors, right? You might find the person, etc. Yeah, I see that people are joining. Those who have joined, if you haven't completed the poll, please kindly make it while we're speaking. It will take you maybe 10 seconds, 15. So if we talk about the geographical focus, angels actually, it's, I'm sorry, just a couple of seconds, that's a coffee machine. Usually the geo focus is regional. Angel investors, they're quite close to the projects they invest. So usually they are around those ecosystems, which Silicon Valley, New York City, Beijing, Shanghai, etc., London. If we talk about the VC, the venture capital, they might be from regional on early stage to national to even global in big funds. So they cross the whole spectrum of geographical focus. Term sheet is something which is being negotiated about before the deal is being done. So actually, this is the summary of the deal, the terms, and you have to agree on that firstly before you make a deal itself, and you pay for to legal people. So angel investors, people who you might negotiate much easily rather than with venture fund. If we consider investment vehicles, which I use, but maybe not vehicles, but investment securities here, angel investors will invest through common stock, preferred stock, convertible debt. We will be covering this later, but the idea is angel will be making this any type of investments just to be in the good idea. Venture funds usually will be invested through so-called preferred stocks. Preferred stocks, they are in the capital stack, they are higher than the usual common stock, right? First, so the idea is easy. First, the VC fund will get his money, only then founders will get their money. Equity staking, we have already covered. So angel, it's a wide spectrum for angel investors and VC funds altogether, right? In the round, we'll get on early stage 20+%. On later stage, it's becoming less and less. Typical post-money valuations, it's the value of the company after the investment has been done, is maybe less than 500,000 to 10 million with angel investors, and in case VC fund is invested, it's millions and up. Recent valuations are slightly crazy, and we'll try to show you today something from the market. Due diligence for angels relatively light and fast. Conversation will be fast. If there is a chemistry idea, is great, angel will give you money. With VC fund is relatively slower, more methodological, but even now it's still fast. In comparison with corporate finance, both of these things are quite fast. It takes days in angels, so hours, maybe days and weeks in case of VC investment. Long-term value added provided by angel investor is operational experience. He can share his experience. He has invested already in many companies before. He can provide you some common sense advice how to avoid stupid mistakes and things, and maybe even specific industry expertise. Usually those people are not just somebody who doesn't know anything, they professionals in particular area. VC fund will provide you experience in managing growth, usually, right? Because this is where they invest. They have deep pockets, so if money will be needed, it most probably will be found. Networks of additional capital, and of course, experience in managing exits or IPO in case it's a big company and IPO is making sense actually. In terms of time, target time exit or IRR, it's angels can wait a little bit longer if the project is great. So it's slightly maybe more, it's 5-7 years. And in the case of VC fund, it's slightly less. I mean target exit time, right? In practice, this might be longer, but the idea for venture fund, remember, is first of all other people's money, and second, the term of the fund is only 10 years, right? So you most probably want to get your money back from the projects in maybe 5 years. It might be 3, it might be 7, but the idea is that usually you have investment period 3-5 years, and then you have another 7 to 5 years to get out of investment. So if you invest somewhere in the middle of investment period, you have to get your money back before the end of the fund's life, which is 10 years. So that's logical. So far so good. Any questions? Okay, we'll proceed. I again remind you, please kindly answer the poll. It's I see from 21 people, 16 has already answered. I just need to get the idea how many of you actually still need some assistance with books and not only. Okay, now let's look at the difference between VC fund investments and traditional private equity. First of all, remember that leveraged buyout strategy in private capital and venture capital, actually two main categories of this private capital. Venture capital investors may have a specialized industry focus. They try to find the next star, right? It's not Facebook, but there are a lot of other stars already in the market, both private and public. So it's all about this power law, which we covered recently last time, right? It's trying to find one or two great investments. On the other side, the LBO firms, they generally invest in portfolio of firms with more predictable cash flow patterns and outcomes. So it's closer to investing in portfolio of public equity. So it's to some degree only, of course. Venture capital seek actually revenue growth, the company growth. In the situation, in the case with LBO, the focus is more on the growth of midline, right? Metrics. It's EBITDA or EBIT. You should grow this metric because enterprise value is usually the multiple multiplied by this particular measure. It's when you want to make this exit. And here, of course, we should add the decrease in debt, right? So corporate finance. So actually, you have to increase the equity value of investment. You might make it in 3 ways. You can get early into the cycle when the multiples are low and then they become high. Second, you will increase the thing which you multiply by the multiple, which is EBITDA or EBIT usually, and you will decrease the debt, which actually provide you additional extraction of equity value. That's only 3 ways how they make it. VC funds usually wins by investing in the right startups, while these buyout firms actually they see multiple growth EBITDA and debt, as I already mentioned. If we put this into the table, so simple thing, buyout, it's steady, predictable cash flows. In venture, it's low cash flow predictability, and cash flow projections may not be realistic. Usually they are not. And bifurcation, I don't know, or dispersion of those potential scenarios is much more crazier than in terms of buyout investments. In terms of buyout, the targets are usually excellent in an excellent market positions. They might be niche players, or they are relatively big players in established or still growing market. In venture investments, there is a lack of market history. Market might be new or unproven, or it will be still early stage venture. There is a significant asset base in terms of buyout investments, so the company has hard assets. If not hard assets, it still might be a lot of code or IP rights, etc. So if you look at the balance sheet of this company, you will see a lot of numbers which actually are on the asset side, right? Besides the cash. In terms of venture investments, usually the asset base is weak, and you only expect that to appear later on. The management team in buyout investments is strong and experienced, usually people with corporate background. And when you invest in venture company, it's usually newly formed management teams, especially in early stage. They might have strong individual track record as entrepreneurs, but as a management, they are junior. In buyout investments, there is an extensive use of leverage, different types, senior, junior, mezzanine. In VC, usually equity funding is used. There is a so-called venture debt, but it's on a growth stage already. It's when the predictability of cash flows is much easier. So actually, for instance, they might be a SaaS company, which software as a service, which actually gets its revenue from subscriptions. In this case, banks can at least predict some cash flows and somehow provide loans or special private venture debt funds. They can have this scoring procedure to provide money. Use of leverage here is rare and very limited. Risk is measurable in terms of buyout investments. Remember, businesses are mature or close to be mature. Operating history is quite long. In VC investments, assessment of risk is very difficult. From time to time, it's just new technologies, new business models, or new markets. So operating history is absent or is very short. It's difficult to make assumptions here. And when we talk about buyout investments, the exit is predictable. It's like secondary buyout, which means that you provide it to another fund, or it's sell to strategic buyer. You have the M&A industry, or it's an IPO when you just make the company public. In VC investments, exit is difficult to anticipate, actually. It might be anything from just bankruptcy to trade sale or secondary venture sale to IPO if the project is very successful. In buyout investments, we usually have deal with established products. In VC funds investments, usually we're dealing with technological breakthrough. In buyout investments, there is a potential for restructuring and cost reduction when you make an investment, and this is part of the value you might create. In venture capital investments, it's vice versa. Actually, there are significant cash burn rates, and cash is still required and will be required for many years, usually into the future, to ensure that the company is being developed and finally become commercially viable on a cash flow basis. So usually when you invest in venture, in startups, or both later stage or even early stage or later stage, it's still negative cash flow company. You have to understand that. Otherwise, it will not attract investments, right, in equity. The working capital requirements in buyout investments are usually low, and from time to time, working capital is the source of cash out. In terms of VC investments, expanding capital requirement is needed. So actually, you in a growth phase, you will be just increasing your working capital if business is successful. Usually, buyout firms provide like full-blown due diligence. before they finally invest, they make financial, they make strategic, they make commercial, they make legal, tax, environmental due diligence. So it takes the whole part of the process. In venture capital deals, primarily technological and commercial due diligence being done before investment. There might be some other due diligence things, but still here, because you have less information to analyze, so the due deal here is slightly different. It's financial due diligence is limited as operating history is short, right? Buyout firms monitors cash flow management. They monitor how the strategy is being implemented and what is the business planning process and all things like that, more corporate finance stuff. The venture capital firms, they actually monitor achievements or so-called milestones. So when the company have, I don't know, to issue another product or to adjust another one, or I don't know, go into another geographical location or market, and etc. etc. So this is much more important rather than the cash flows. Of course, cash flows are important, but if the business is promising, I would say not still successful, but promising, if the milestones are being hit, then you will get your money, especially today. Returns of investment portfolios in terms of buyout portfolios usually characterized by low variance of returns, right? So bankruptcies are rare here. Usually you have your outcomes in a more narrow band. In terms of VC investments, as far as you remember the Power Law, usually your portfolio of venture capital investments is characterized by very high returns from a limited number of highly successful investments, and you have significant number of write-offs or just low performing companies. So the distribution is very much different from what you have in buyout investments. And this is the last page on this. Large buyout firms themselves are generally significant players in capital markets. They are big players. Venture capital firms tend to be much less active in capital markets, and themselves they are smaller. Like the funds smaller, the industry smaller, the players are smaller. In buyout investments, interestingly enough, most transactions are auctions, or at least they involve multiple potential acquirers. So an M&A transaction. In venture capital investments, especially in the earlier stage, many transactions are so-called proprietary. They are the result of relationships between VC capitalists, angels, and entrepreneurs. So being a part of the ecosystem is very important here. Otherwise, you might just miss interesting opportunity. Interesting enough that strong performing buyout firms with time tend to have better ability to raise larger funds, right? And next funds. With venture capital firms, the strategies are less scalable, actually. The increase in size of subsequent funds tend to be less significant. Nowadays, given the amount of money being like printed globally, of course, we have an uptick in the average size of the fund, but still, on average, you can see that with venture funds, it's more or less the same, the next fund, or slightly more. However, in buyout investments, you might go, I know, from 2-3 billion fund to, I don't know, 7-10 billion fund sometimes. So actually, the fund might be a couple or 3 times bigger. And when we talk about the general partner or the management team itself, like who is managing these investments, in buyout investments, there are more lines of sources for the general partner. They get the carried interest. Remember, they get the transaction fees, and they get monitoring fees. Of course, management fee we don't mention here. And on the other side, in venture funds, usually carried interest is generally the main source of variable revenue to the GP. Transaction and monitoring fees are rare in practice in these types. So here we see that buyout investors and managers, they are even more money motivated than venture capital investments. If we look at this risk spectrum, like risk return characteristics, we can say that seed angel investors are taking the highest risk, and they of course expect the highest return for equation to work. On the other side of the spectrum, we have private equity industry, which actually tries to invest in the lowest risky companies. If we look at companies from seed stage to growth mature companies, and venture capital is somewhere in between. So it tries to get something on the early stage, sometimes together with angels, to the situation when VC funds, some big funds invest in growing big, large private companies, when sometimes even private equity firms are investing together with them. If you look at the ladder of finance, so with stages, your risk is decreasing. And of course, when the risk is becoming lower, the valuation should become higher. So on pre-seed stage, you have your money, friends, family, and fools. Before seed stage, you might get some R&D or grant funding. Then you get money from business angels, VC funds, early stage funds. When you have already shown traction and the company might show early growth, and the traction is good in terms of metrics for VC, they will invest. And finally, it might be exit or trade sale on IPO. There is another interesting picture. It's this one. I decided to put them all together for you just to look at this from different angles. So usually you have a concept of the company. You have a startup when you start making your efforts as a company. Finally, you have growth, and later stage you become public or you sell the company. So what you have here, the highest risk, of course, is to the last, is to the left. This is the red line. You get grants or friends and family money on the concept stage. Some angels will join here, and you will get some seed capital from angels or early stage venture capital on the startup stage. Here, most probably, you will show your first sales. So actually, you have already put a lot of your money and money of angels before you show any sales, on average. Of course, not in every case, but on average. And if sales is picking up, so-called the traction is shown, so there is a traction in products of the company, the venture capital will invest. And as you see, the green line investment will go much higher. So you have this steep line, and then the sales are keep growing. You already don't need investments because you start getting money from the economics. And then you have later stage investments. The company either become public or being exited in another way. And this is another interesting picture. So actually, in terms of revenue, this is the typical life cycle. There is a so-called valley of death when there is no revenue, there is no money out, there is only money in. And this is the seed capital, friends and family, fools, yourself, and angels. And maybe you will become break even somewhere in terms of on the cash flows, not income here. On early stage investments, you get more money, etc., etc., etc. So something like that. Okay, this is maybe a short, no, not yet break. Guys, so far so good. Any questions? Please don't hesitate. And okay, we will continue. Those who have not answered the poll, please make it. As far as I see, we have only one person who have not completed that. Now let's look at the investment process of the VC firm. This is the screen from the book, which you should start already reading. In a nutshell, you screen hundreds to 1,000 of initial proposals. You choose maybe 10 of them for preliminary due diligence, where you will put a lot of efforts into the process. Then you finally will get maybe 3 good investment ideas, and you will provide your term sheet. So actually the terms on which you as a venture firm will be able to invest into the company. Some of those term sheets will be rejected by the founders. You will have, I don't know, 2 replies, and you will start your final due diligence, after which you decided to invest only in one company, for some reasons. So just for you to get the flavor how it works. It might be different, the numbers might be different, but the idea, the scale of how it goes, it's this one. Actually, the due diligence process should be split basically in two parts. It's the initial DD and which actually and business DD. Due diligence is actually getting answers to your questions, right? And it is important to ask right questions, open-ended. When you want to know more about the company, you have to get as much information as needed. So let's look at initial screen. What we are looking for? We are looking for quick red flags here. Something which will say you stop. Don't waste more time. Go to the next idea. And here you should ask yourself first questions. Is the opportunity consistent with the philosophy of your firm? So is it the stage you are focused on? Is it the geography you are focused on if you have focus? If it's the right size of the deal? If the industry sector is one where you actually want to invest in? I don't know, if you're a technology venture capital firm, maybe there is no sense to invest in electric vehicles. When I say technology, I meant tech light asset companies like software as a service, anything about software. You need to make two actually tests. First one is market test. Does the venture have a large and addressable market? Always ask yourself this question. Actually, VC funds, they're asking themselves every time. So when they get the idea, they ask first of all, is the market is large, or is the new potential market can be large? Sometimes we should talk about new markets, but it's very important that the market already large or it has the potential to be large. Then investing into the company in the large market with a strong team management and funding might be very successful. But the second test is the management test. Does the current management team have the capabilities to make the business? So it's more about art and science, but it is very important. It might be a good market, growing market, but the team might be not the right one, not capable. The business due diligence, it's actually evaluating the investment potential. So here you have to split this into the several buckets. And first of all, it's management, it's people, as they say. Then it's market. It's when you go deeper in each of them. First, you already answered yourself that two market and management test potentially. The answer is yes. Then you have to go deeper. Market, large or high growth market. What is the competition into the market? What is the dynamic of competition? Because some large markets with transformations, they actually have very dynamic competition pattern. Most important question here is if the competition is low today, what it will be in 1, 2, 3 years when you have already invested into the startup, but it's still in its efforts to become successful company. Next one, product and service. Is it a must-have product or it's nice to have product? What actually customers pain does this product or service kill? Can it be profitable? Or in other words, will be people willing to pay for that? It's very important. Actually, what is the business model? What is the unit economics? How it's all put together? Actually, does it work on different set of assumptions? What is the sensitivity to those assumptions? So the areas of analysis here actually become wider and wider. Management and team, markets, right? We should, of course, then answer ourselves, who are the customers? What is the bargaining power of those customers? What is the product? What is the technology used in our company, this startup, right? The competition, how we might project the dynamic into the market, the financials. What are the channels through which we actually sell the product or services? How costly they are? What is the bargaining power of those who actually honor those channels? Who are the partners, or do you need the partners? The more partners you need to get your business working, the worse for you. Actually, how much money the enterprise is needed? What are the transaction terms? Are they making sense? What terrible things might happen which actually kill the business? What is the exit strategy? How we will be exiting? Is the company already big enough to potentially make an IPO, or is the company is small that we cannot expect any IPO exit? So actually, then we should understand that the channels of actually of exiting, they are narrow. The channels are narrow, so you will have to find either strategic buyer or another fund, whether VC or private equity, to sell this to. And business model. So actually, lots of questions appear here, and let's look at all of them in pieces. First of all, who are the founders and what are their background? This is what is being asked, one of the first questions. Actually, who we are giving money to? Who are those people? What they have reached in their life? What are their reputation? You have checked that. Next, do these people have relevant experience or they first-time entrepreneurs? It's very important. VC investors like experienced people. Of course, it's much harder for first-time entrepreneurs to get institutional money. How well these people function as a team? They might be, let's say, 3 of them. Each of them is perfect, but altogether they might be a bad team or not that good team. So there might be some potential for conflicts or inefficiencies, or I don't know, the chemistry is not that good. All the things which actually can bring you to the point when they split and actually the business idea changes, right? One of them will start another business of the same type and etc. Do they have a track record of success, especially together? If it's a long-standing team, that's very positive. What critical resources do they have access to? So in case they will come across the difficulties, what types of resources they might use to overcome them? How well do they evaluate risk themselves? What is their process? How much they are detail oriented? So a lot of questions should be asked, not only these ones. In every time is different, but what VC funds VC managers are doing, they're trying to, let's say, have this scoring for themselves, right? To get the flavor, whether in the final they like it or not. Many things will be taken into account, but each of them is quite important. There should be a good, as we mentioned, track record, but first of all, how well does the team hit milestones and execute? It is very important because, as far as you remember, VC funds, VC investors, they actually track these milestones. So if the team is capable to, I don't know, meet the deadlines, hit the milestones, which means, I don't know, launch new products as they promised, execute changes of, I don't know, pivots of businesses, that's very good. If they always ask for additional time or money to get to the point they promised, that's not a good sign. Communication skills, interestingly enough, but it is a very important point, because convincing power of these people is something they will be needing when attracting money in a situation when there will be scarce of capital in the market. From time to time, this happens, right? So convincing power is very important. How ready they are to answer any detailed questions. So the quality of pitch to investors is also important. Here, the next question that will be asked is whether the team is already complete or still some important hires are needed. If important hires are needed, that might be bad, that might be good, but of course, having a complete team set up already ready for the business trip, that's better. But if additional hires are needed, you have to understand how critical it is. Next skill set should be analyzed. Is it balanced or there are, I don't know, any gaps? For instance, there are three founders and each of them is very good in some particular area, but another important particular area, I don't know, managing people is a gap. So all of them are nice single players and have great hard skills, right? And maybe not bad soft skills and convincing, but they have never managed other people. This might be a problem. Not always, but you understand me. And then, do they exhibit the capacity for sustained effort? Will they be making another attempt? And actually, it's all about also the motivation of those people. Will they stay when things will get much worse, and they will understand that they will need to wait for maybe 2-3 years before things will become better? Will they still love this project, team, and etc.? So a lot of not only technical and managerial things, but psychological things, all connected with the actually people's life and the way they see themselves in their life. Next is market. It's first of all, is it a new market or it's existing market? So actually, is it a blue ocean or red ocean? And once you have answered this one, you should see what the market boundaries are, right? And is it a growing market or it's a compression market? What kind of business in economic sense will be created in this particular market? So actually, what the startup will change, and is it making sense? Is it a large market? Is it large enough? And even if the answer here is yes, it is large enough, the next is it addressable? So actually, can a company address that market, get the access to that market, right? Because there might be a situation that you need somebody in between to get to this market. So maybe not a good example, but still, you are a shop, or you, I don't know, you have a retail market currently, very hot topic. It's coming through the huge transformation, right? We have online delivery things like in Russia, for instance, it's Yandex.Lavka, Samokat, etc. But this market is rapidly changing. I'm sure you don't want to wait for, I don't know, half a day or the whole day to get your deliveries. I hate that. I still walk to the, of course, on my own because I don't want to wait half a day. But if I will be sure that in 1 hour I will get what I need, I will stay at home. And the companies are going into this fast delivery part of the market. So actually, that's the same things being sold, right? But just different delivery. And here there might be a situation that in the middle, there is somebody who actually can catch the value of this value chain, right? Somewhere where it's difficult, you have a lot of data, etc. It's just one of the examples. So you always ask yourself how addressable it is, and if you can address, well, it's more or less the same words here. If you can address the market through somebody only, not directly, then that might be a problem. It's in the end will be who is stronger later on, right? Who will get more bargaining power. Then, if the market is growing, are the underlying drivers for the market to go for place, right? How sustainable they are. Structural drivers, you should also always understand that. As far as I remember, it's like in financial markets, right? There might be on a short time frame, there might be a bull or bear market, but if you change the time frame, the picture might be completely different. Same story here. You have to change the window, understand what are the structural fundamental drivers here. And always ask yourself a question as investors, what is the capital intensity? Actually, how much capital should be invested to get the, I don't know, the part of business or unit economics in this market? So how much CapEx and OpEx and working capital should be in place for the business idea to work? So with examples here are software and non-software business. With the software, you have to put a lot of money into IT efforts, right? You hire professionals, engineers, programmers. They make the product. Finally, you test them. Once it's ready, you don't need more. money for this particular product. You will be adjusting that, making adjacent products, but that's it. It's asset light. It's asset light. The problem. I'm sorry. You don't need working capital. You just invest it at the start, and you have the result in the end. And just you keep selling these copies. And of course, it's vice versa with anything which always ask you for additional capital. It's very important to understand because your cash on cash returns, your IRR returns will all be dependent on that. You as a venture company invest venture funds invest into the company, and the company itself investing into the projects in these business lines. And don't forget about regulations. Actually, regulations might totally change the business case. And there are people who actually focused on the extraction value in the ideas from the regulation. There are such kind of investors. They understand the structural drivers in the regulation, and they expect particular changes into particular areas of the markets, and they go there before that. There are people like that. Interesting approach. This is the, oh, I'm sorry, I see somebody in the chat. It's from Maxim. In some deep tech sectors, even PhD is required, and Scopus ranking might be one of the factors. There are a lot of things. Yeah, thanks, Maxim, for that. Yeah, PhD is quite important. Actually, in high tech businesses, the more valuable the person and the brains of this person to the business, the more value you attract to not assets but to people. It's quite common in these areas that people are just being bought out from the startup. So the problem here for you as a founder who actually has these people as a part of your business is that they might be offered other terms, better terms in other place. And here chemistry and relationships might play a role. This is the picture. So actually, you might have the potential available market, the global market in particular area. I don't know, software as a service, anything. But then you cannot reach all that market. Let's say even if in the United States, you will not be reaching in particular, I don't know, Malaysia or Chinese market of these particular types of things. Then your total addressable market is becoming less. Then you have this so-called served available market, right? Which actually you can actually serve. So part of the market is already like busy, right? You will not be there. And you go from big to smaller things every time, trying to understand actually what is the true target market for you. So serviceable and obtainable market is the market which you actually can already get access to, right? And still there are many players there. So in the end, people who are saying I don't know, making the global rent market for households global, it might be, I don't know, trillions. I don't even know the number. But you understand that local rent player, let's say Xi'an, will never be renting flats in China, in States, in Brazil. It is a local player. So always take it with a grain of salt when somebody is pitching you with the project with the global number of the global market. So always ask yourself, what is actually the true market which we can get access to and compete on? It will be much smaller always. This is the example of the healthcare example. So actually, there is a chronic care conditions market. I don't remember even exactly, it's several years picture, it's already several years outdated, but still, you have a chronic care conditions market, global, right? There is a particular chronic care management market with particular number, I don't know, types of disease, right? Then the actually addressable market for the startup is only part of the global chronic care condition. Then the served available market, and the part of that is only the target market for this company. So you see, they always remember this onion picture and try to get the understanding what is the true target market for the business you are being pitched with. actually the founders, those who pitch that to you, should be able easily tell you about that and have arguments in favor of these numbers. If they don't, that's a problem. They actually don't understand where they are going. Next piece is customers. Who is the target customer? Actually, does he exist? Really? Not in the mind of the founder, but really. What is his or her profile? Again, why customer would want to hire the product for particular job? Always try to think in these terms. So actually, you as a customer pay for something because this something makes particular piece of job for you, right? Somebody makes a delivery for you. I don't know, when you, I don't know, pay for something like Excel, it makes calculations for you or make graphs for you because you need it in your job and etc. So why customer would hire the product or a service for what type of job? And why should the customer will be paying for that type of job? What are the alternatives? And how many customers does the venture actually target? And remember, always ask a question. Customers and users, are they the same? In case of Google and Facebook, actually, users and customers are different. That's not the same. Users, it's you and me, but customers are big companies who pay for advertising. The source of income for Google and Facebook is mostly ad driven, right? And that's corporations who actually buy our data, which we provide freely. Always ask yourself, where the money? Who are the customers? Where the money? If you talk about product, you should understand what type, what stage of this product is on. So actually the product life cycle, where we are. Is it already ready product? Is it still MVP, like, which means minimal viable product? It is being sold, but it's not perfect. It should be improved later on. But still, people already, the customers already pay for that. Is it a prototype or is it just an idea? If it's a prototype, is it working already? If yes, plus. Which means because technical risks are mostly mitigated, right? If product completely and fully developed, that's perfect. But you should understand that the valuation on this stage will be much higher, of course, of the startup. Next question, what is the actual value proposition of the product? So actually what the product is, what is it for the customer? What pains does it cure? And actually what gains does it give to the customer, right? Because it should be simple. Product should cure the pain and or give you pain or give you gain. So it either helps you to avoid something or it helps you to get, I don't know, extract value from something, right? And again, nice to have or must have product. Nice to have, you know, it's Pokemon, it's nice to have. It's not something you really need in your life, right? But must have, it's something, I don't know, everything connected with your health, it's a must have product, right? Is it going to be, again, a habit forming product? So actually, will the people will change their habits if they start using the product? If yes, why should it change customer status? We started using Gmail, most of us, I don't know, hopefully, so, but then it became a habit, right? We might have other types of mailboxes, but the idea is we started to use electronic emails, and it is a habit now for most of us. So for Google, its user base is stable, so the customers pay more. Next, about the product. Does this product actually exhibit scalability? Don't forget that if you need the same amount of capital to get the same unit economic back, marginal part contribution, if there is no scalability of this product, it's not a good idea. So actually ask yourself, if the company becomes 10 times more, 100 times more, how it changes, how the product it changes, how investments into the product is changed, and is it actually scalable at all or not? If not, then you might not expect big growth numbers. Does the product show traction? So actually, does market demonstrate adoption of the product? So people start using that, they are being engaged, they spend more time. I don't know, if we take online gaming, you see that in particular online game, people are spending more and more time, or at least it's not going down. Or people are not like deleting the program or application next day, right? They stay, they go into that, they keep playing, they're not deleting that. That's good. That's a good sign. And market ready to pay for the product? So once you put additional premium features into the product, in this case, are people willing to pay for, I don't know, Sworn or Gun into this game, etc. Always remember about the relationship between profitability and price, right? How much profit you get, and depending on the price you charge. And is this one product enough, or the company will must to have adjacent products or another products? So from time to one product is a risky venture, right? And there might be a situation that it's just go out of favor, and that's it. Can demand from the market be proven without large sunk costs? So if you have to put a lot of money into the ground before you get the answer to this question, this might be not a good idea, right? So in a nutshell, hypothesis should be tested with a smaller amount of money. The smaller the amount of money needed to test a particular hypothesis, the better. So on the product wise, these types of products and companies making these types of products are better because they will be able to make more trials before they get the product market fit. And once the product is ready or about to be ready, ask yourself a question: is it superior? Take competition into account, and get to know whether there are attractive substitutes. Then maybe it seems like we already have to make a break, right? If I'm not mistaken. Can you please remind me if it's the time? Okay, I assume let's have a break for 10-11 minutes right now, and let's continue after the break. Yeah, thanks, Victor. Yeah, it seems like we should have it. Okay, see you in 10-11 minutes, and I don't know, don't hesitate to reach to your colleagues who are not on the lecture. See you soon. Okay, let's continue now. There are also a list of sanity checks for potentially good products. So actually, your product might be good for another company if it complements fast-growing product line. It might be a disruptive product with potential to damage a large company market position, which means that such company will try to buy you out, first of all, to kill, if not able, then to buy. The product might be filling a newly emerging gap in, again, big companies' product line. So as far as I understand, these large corporations, they try to fill this full product line mix, and if there is a gap, they will try to either make it themselves, but if it's difficult, they will buy some company which actually already has this good product. The product which actually is based on strategic patents that a buyer cannot risk having might also fall into this competitor's hands. So the idea, in other words, if to have this product you need strategic patents and they are just protected, then the company will just buy that. Or if another company, your competitor, big competitor, wants to buy these patents, you will try to buy this first. So there might be a situation then strategic patents can be only in one company and there are several competitors. That's really good position for you to sell your company. There might be a situation then there will be a lack of sales, but the product might be accretive or profitable in the hands of larger sales force. So if you sell it to existing customer base, in other words, if the unit economics is becoming much better on a larger scale, but it's difficult for the startup or the venture to get to that scale, but it's very easy to get that scale inside a big company, that will be a very good deal because negotiation will be easy in this case. Interestingly enough, that product cycle actually shortened in the recent decades. It's the Harvard Business Review picture. So usually you have innovators or trial users which actually try this new products, new services. Then usually you will have this gap, and then you will have early adopters, and then the early majority will join. So usually that's a hill, but this hill used to be stretched into the timeline. It is now much shorter. And it is important to keep in mind that actually a good startup or good company has to always invent new products with these short cycles. The reason is simple. Once you on the peak of this cycle, you will have problems, right? Because no more growth from here. Just for you to keep that in mind. Next piece of due diligence is technology part. So first of all, you have to consult with the experts into the field, right? So if it's a special, there is a special technology or special nuances, you better consult with people who understand a lot in that. And you might contact particular PhD persons or technical consultants just to tick your box, right? To be sure that this is something you want. Also, if it's a technology, the due diligence on legal protection of patents, as well as trade secrets, should be done before the investments. If you don't have particular IP rights at the moment, don't forget to ask yourself a question, the venture itself, will it be able to create those valuable IP rights? So there might be a situation that the product or service will not be still accepted by the market, so you will be somewhere early into the stage. They might be even not traction. But as a result of the efforts, if the valuable IP right will be created, actually the valuation of the company will skyrocket here to some degree. And this is especially the case for, I don't know, healthcare companies. The investments in venture healthcare companies is totally different from investing in venture software companies. Usually software companies have earlier traction and earlier cash flows. and they are scaling. While with healthcare companies, it's not irregular situation when even after 5-7 years of investments, when you're making successful exit, the company still doesn't have cash flows. With healthcare, this is possible. It is a special industry in this case. And always don't forget to understand, is there a first or last mover advantage in this technology? That's more about something to talk about of technology consultants. But remember that Facebook was not the first social network, Google was not the first search engine, and etc. Right? Finally, successful companies are not always those who were first in the market, and maybe last or close to those who was last. Competition is something don't forget about for sure. If the venture is stepping into an established market, that might be a problem from the competition wise, right? If it's creating a new one, it has some first mover advantage. It all depends on how it will use that. When you look into the market, you should understand the barriers to enter to this market, to this particular niche. Is it easy or is it hard? Is there any IP rights protection? So if to be in the market means to have to own particular IP rights, that means the barriers are at least higher. That's not that low. Again, is one product enough to stay competitive in this market? And how fast this product will become obsolete? Remember the picture I just have shown you several minutes ago? Don't forget about that. Who are the main competitors? And importantly, what resources do they have? It both practically and important to understand with established markets and public companies, as well as new niche markets, as the one I mentioned today, which is fast delivery. It's a hot market. There are a lot of capital going into that. More and more startups are being well funded. So the resources in terms of money is not a problem for some of them. And how this money will be used, right? You have to understand that it's becoming more important that teams become more a factor of success rather than capital, but still there will be a period of time of hard competition, right? Because those huge amounts of capital, hot capital, which came recently in one year half, less than 2 years, okay, they will be used on marketing, on damping, on customer acquisition, and it will be huge competition to some degree. Then there will be a case when milestones will not be ticked and some companies will go bankrupt or will not get additional capital because they are loss making, right? And the competition will decrease. But the period of high competition is something you should be aware of. Yes, and how the company's positions against these competitive threats is something you should take into account. And yes, I here the fragmentation of the competition. It's also might be important, right? Whether you have 100 companies competing in one market, but it's still fragmented, or you have two big competitors, huge ones, who actually can even play together to kill you as a newcomer. It's a different types of competition. Projections, something which is more closer to you and me, right? Financial things, Excel and etc. numbers. So when you analyze the projects, always ask yourself the question of whether financial projections are reasonable, taking into account all we have previously discussed, right? And your particular expectations. If financial and operational metrics connected into the model, that's very good. It's not always the case. It's not always the case even in a private equity project. So I'm sure those of you who are familiar with financial modeling understand what I'm talking about. But there might be a situation that your operational metrics or milestones don't have any connection with financial projections, which are being maybe made by a separate person for you just to pitch the project, right? So do your homework, check these things, make your projections. If future financial risk is manageable and you understand that, that's a positive. So you have less risks. Capital intensity of the business. Again, I want to stress that again here. Remember, software, hardware, real estate, totally different capital intensity of the industries. Business models, very important. Today, one of the areas where innovations are appearing is business models. So actually, fast delivery is a good example here. It's the same products being sold, but the model how they are sold is different, right? You are not longer going into the supermarket. I know you just get this by delivery. You are buying the same product, but the channel for which you get this product is different now, right? And it means that supermarkets are suffering because those who sell you through fast delivery applications, they actually have their small dark stores. They are not always buying it from supermarkets. Actually, it's another model which will be most probably will be going down. It doesn't work very fast. Always understand the underlying margins and scalability of those margins. Unit economics, so lifetime value of the customer and the customer acquisition cost, two things which you should at least keep in mind and ask questions about. So the lifetime value is, in simple terms, is how much money you get from average customer through his life as a client. Sooner or later, average client will go out from you as a business, right? But there is a time when he is still a client, you have money from him, you make earnings. But to get this client, to onboard him, you have to pay in advance. This is your cost of acquisition. And they should be a reasonable balance of those figures. LTV usually always have to be higher. If it's lower than CAC, then the unit economics is awful. You will be losing money. And it should be at least 2, maybe 3. It's good. 2 and 3, it's at least 2 and 3. It's good. But good businesses today, they're showing dozens, like 10s, 20, 25. Pricing power. Does this business model has a pricing power? Can you increase the value? What's the elasticity? Are you good enough? Are the clients sticky with you? So it's all about trying to get additional margin. And cash conversion cycle. Do you have to put money in advance so your working capital is positive or your working capital is negative? Remember, Amazon was a loss-making company on net profit basis for many years, but it was hugely growing up and up and up in public markets. And one of the reasons was it had a negative cash conversion cycle. So the bigger the company was becoming, the more cash it has. Not more cash it was invested into the company, but actually it was producing cash with its growth. And it was an additional booster to that. It could play with this cash, right? So actually it was totally different with a regular retail store. When you have to first put your money in, have a working capital, I don't know, if you sell books, you have these books, you bought them and you try to sell them with time. With Amazon, that was differently. They managed to do this system which actually was producing cash from growth, not consuming cash from growth. And they were playing with that. They were buying other startups, I don't know, making a lot of hypotheses, going into the other markets. One of them shoot out, which is web services, and etc. So that was the source of investment. They were not attracting additional capital when they were public. They were using the cash they had and producers. Projections, sale volumes for break-even points. Ask yourself whether they are realistic. Here I have examples of Uber and Lyft, which are actually not technology companies, right? It's actually the companies which are so-called tech-enabled. The technology is just enabled to change the way you get your taxi. But companies themselves, they're not something a lot of technology about. And there was some analysis in the web.
that the markets for this company is too small. So for these companies with their unit economics and level of competition, to become bottom line profitable, you actually need much higher, much bigger markets. It is maybe changing now. They all go into these driverless things. They're trying to somehow change their business models or get adjacent products. So not only one product, but other. But still, it's something to keep in mind, right? These companies are not something very much technology. It's tech-enabled company. It's just a middleman into the historically old market, which is taxi, right? And it's not Microsoft, right? I don't know. It's not Tesla, which is not also is not a very good example. However, quite interesting in terms of valuations. Cash financing. There is a so-called chasm between early adopters and early mainstream users. So actually, if you have a product market fit, you will have firstly big growth, but then all of a sudden it will stop. There will be another valley before so-called mainstream users will go and will join this product, will start using that. So it's usually it's a problem for venture firms to jump over this stuff. So there is a big bump on the road. Don't forget, the company will have to finance somehow this chasm, right? And we'll have to somehow get to this mainstream users, somehow attract them, right? Those who are more conservative. And actually, do cost and return on investments marketing makes sense? If you spend a lot of marketing, what are the metrics? The people who are professionals in marketing will have to answer these questions, but you will need to understand that as well, right? And if you are attracting customers for $50 and you are making only 25 on them, and also bear additional cost of all the other parts of the business model, well, it doesn't make sense for you as an investor. You don't have to invest in this company. The bigger the financial risk, remember, the bigger the potential for dilution, right? What I mean? It means that even if the company will be able to, the founders, they're very persuasive, they can attract capital. But for you as an investor on the earlier stage, it means bigger dilution later on, because the company most probably in some situation will need more capital, which means you will be diluted. So, right, more capital stake will be given to new investors. So the less the financial risk, the better for you. Your capital stake into the company has less risk to be decreased significantly. Channels. Importantly, first, how does the product or service get sold? The distribution channel, how many of them, and actually who controls them? And it will help you to answer the question, is the market indeed addressable? Or actually not? Or actually you just address the distribution channel owner and that's it, where your business ends. And they can, I don't know, stop your business anytime. If you have a short sales cycle, that's positive. If the distribution is inexpensive and these channels are cheap, that's positive, and vice versa. If the customer acquisition cost is low, that's of course positive. If you need to sell directly, that's negative, because usually the cost of direct sales, they're high. If you need channel partners or distribution partners or distributors as a big wholesale player, that's to some degree negative, right? Because you will have to negotiate with them and from time to time give away part of the margin and still bear some risks operational firstly. If the marketing efforts on PR, you don't have to spend a lot of marketing, of course that's positive, right? It's again, in the end, it's the cost of the sale. If you have to spend a lot, that's negative. And very important, the last point here is, are the sales repeatable or one-off? So actually, if you have attracted the client, you sold him the product or service, then the question, do you again need to spend the same acquisition cost to again sell him, or it's already in your, I don't know, platform ecosystem, or he will be just keep buying products or services from you. It's all about those, again, two numbers: lifetime value and customer acquisition cost. If it's a repeatable thing, let's say he will be 5 years with you, so you pay once to attract him, and you sell many times. In the latter case, you pay once, you sell once, and then you again have to pay to attract him. It means that he is essentially not a client anymore. So actually you pay once to attract him, and you sell him once to get money from him. So here the ratio is difficult to make ratio very high here. Business wise, it's difficult. If we talk about partners, how many partners does the venture rely on? Don't forget to ask us questions. And how are they acquired, motivated, retained? The simple example here, and how critical they are. The simple example here, let's say you are a pharma producer in Russia. We don't have big pharma producers in Russia, but okay, to some degree. But the wholesale distributors of drugs in Russia are quite powerful. So for you as a producer of a drug to put your product into the pharmacy costs you quite enough, and you, especially at the start, you have to pay a lot. So this is just one of the examples for you just to keep in mind. Try to avoid that. So if the venture is avoiding that, not relying on that, that's nice. And money, it's all about money. All the investments about money. Again, what is the capital intensity of the idea? Do we need to put only once money, or I don't know, we'll be putting money indefinitely? Just another great idea here is airplane. I haven't heard about airplane venture finance, never. Actually, globally, we have only two producers, Airbus and Boeing, big ones, right? Who produce big fleets. Very capital intensive industry, very, and politically exposed as well. Financial until today, how much capital has already been provided to the project? How much cash is in the project as of now? What is the balance? What is actually the cash burn and current runaway? Current runaway means how many months with the average of current cash burn rates is still left before the company becomes insolvent. For you as an investor, it's good if this current runaway is short, but the project is promising. It means you have more bargaining power to negotiate the terms of the deal. But for the venture, it's bad. Usually they need to attract additional money, maybe 6-12 months before this date. Otherwise, they will have problems. Or you will have to either be valued lower or give away. Anyway, you will give a larger stake out to investors. How well does the company spend cash? So actually, what are the uses of cash, and what is the effectiveness of these uses? And new money going into the company. What are the uses of this new money? So actually, the question here may be the following. How much money did the company need to get the previous milestones, and how successful that was, and what will be the uses of newly coming money on what milestones and when? And does it make sense? And don't forget to ask founders the question when there's the time of next need of financing round, especially if you invest in as a venture firm in early stage. That's relevant question. Most probably the company will have another round, 1, 2, maybe more rounds of financing. And you need to estimate the capital needed to reach the successful exit, taking into account those expected future rounds, right? And you have to calculate some numbers from here. Potential valuation, but also your share into the company, which will be diluted. And again, does it all make sense for you as an investor? Transaction terms is also a very important thing. It's main and specific terms, and it will be the next topic that will be covered next time. But still, legal aspects, are they fine? Are there any legal problems or potential problems? What are the so-called showstoppers issues? So you will have to, with your legal team, analyze the pre-existing agreements, the shareholder structures, any loans made to management or to company by, I don't know, anybody. So you will have to get this picture as clear as possible, right? And what are the attractive deal structure and good terms? If investor is unfriendly without key protections, then it's negative for you. I mean, here every deal might be in favor either investor or the company. For if you're an investor, you better have investor-friendly things. If you're a founder, founder-friendly things. What this means, we will cover later on, but just to get you the idea. If you have competitive investors with alternative term sheets, as a founder, that's good for you. You will be able to first choose and increase the valuation of the deal, or maybe get more money. And if it's a manageable round size with syndication, that's also positive. So a lot of things to go through here as well. But it's all to make an exit, right? And don't forget about exit strategy. If you put money in, you will have to put money out, and you want to get positive return on that. So exit types might be early exit, it might be dividend, royalty, or buybacks, which is usually not relevant for venture. And of course, it's for venture investments. Usually, it should be either acquisition or IPO. But the exit strategy might be different. And let's look at some of the strategies which potentially you might come across. The cheapest one is buy the team. No value in business, only team experience is important. So this is the cheapest idea. So if your team just might be bought out, and that's it. The technology, if you have invented the technology, you have IP rights, plus the experience of the team, you can buy this set. It's more valuable. You can buy the future. So there is some limited market acceptance. There is some good add-on to buyers' existing products. So if the acquirer buy the future, it's already not bad situation. If there is already a product, there is early market acceptance, there is traction, there is almost a market fit, it will be more valuable. If it's already a business, it is viable, it is profit on standalone basis, so the unit economics is positive. The whole business might be negative, even on the cash flows, especially if it's growing, that's normal. But if it's profitable on the unit economic, especially in the established parts of the business with longer operating history, that's very positive. And if it still promises growth to the buyer in his product line, with this cross-sell on new customer base, that's positive. So that's most probably, in terms of acquisition, the highest valuation possible to get. Interesting numbers from PitchBook. This is time to exit, median time to exit in years, from first financing to exit by type. As far as you get, it's slightly outdated numbers, but at least they're not exacerbated by the recent things in the recent couple of years. So it seems that it takes on average 5 years to sell the company to strategic buyer, to buyout fund, after the first financing round. With IPO, it's more volatile, and we understand why, because here you're actually more dependent on capital markets, and it takes more to go to IPO, which is logical, right? Because the company should become first bigger, and second, it takes time to prepare for IPO. It doesn't take so much time to prepare for acquisition. So roughly 7 years. Here are some interesting examples. These are top tech acquirers 5 years ago. as far as you see, those companies we all aware about, like Google, Salesforce, like Accenture, they're not standing in one place, right? They keep buying interesting projects, increasing their product line, and incorporating these new projects into the existing business, cross-selling, etc., etc. Actually making the whole ecosystem, I would say, for their clients. Another interesting thing to mention, before the numbers were exacerbated by recent monetary policy actions. So actually, if you look at the last round raised before exit, you will see that most of the exits was after, I would say, rather small rounds, right? So it was seed or series A or B rounds. More than half of the companies exits was already after early stage investments, early stage rounds, in terms of number. So it means that these companies were acquired somewhere, just showing traction and first signs of success and potential growth. And many less companies were acquired in other situations. There are some other things which convertible note, private equity, growth equity, but this is a small number. So just the main takeaway from this picture is promising businesses are being acquired quite early, while they're cheap. So for big tech players, at least 5 years ago, it was making more sense to buy more companies on the earlier stage, either to decrease competition or increase the value of their product or service offering to their existing clients. These are the biggest VC-backed exits of all the time. I'm sorry, I need 1 minute to go away, but at least you can look at this and we will come back. Interestingly enough, that you start seeing here North American companies, right? Like JD.com, Alibaba, and other companies, Kudian.com. Okay, let's continue. Terrible things. Don't forget about terrible things. Terrible things are very rare, but they're possible. And that's, in terms of risks, it's the left tail, if you talk about the market, right? So something which very low probability, but really huge impact. If unexpected lawsuits against the company will be started, most probably the company will die. If there are problems with incorporation documents, you have problems as an investor, right? Most probably consider that as investing into the unexisting company. Or if the company can be harmful to environment, especially today with particular trends in ESG, that might be a great big thing, big problem for the company and for you as an investor. Uh, Theoretical things, but you better check them. Business models in general. How actually the company, the venture, is making money? How all the elements of the system fit into the working whole, right? How is the company actually going to make money out of the processes? And will operate with time. Is there actual potential for high gross margins? The higher the margins, the better, of course, right? But if there is no potential for high gross margin, it means that your company actually has high operating leverage. So in general, your risks are much higher, so valuation should be lower. And maybe this is not the potential company which actually will pay out the whole fund. Is there a potential for recurring revenue streams? Recurring revenue streams is very much important. They are valued many times more than unrecurring revenue streams. So companies which use subscription models, Netflix is one of the examples, valued very, very high. This business model of this new venture you invest in, is it similar to other proven business models or it's totally new? The answer to this question will help you to comprehend the idea of the business model. And does the business model actually pass two tests, numbers test and narrative test? So in the end, does P&L adds up? Again, unit economics and numbers, and narrative test, does the story make sense at all? Not only numbers, but in general, right? For client and as well. And then you make these detailed questions, right? Again, how the company will sell its product or service, channels, or how costly, how much marketing, etc. How the customer will perceive the value of those products and services. Can you find any benchmarks to compare with? If this is the new market, and we see it actually, key market influencers, do you need to target them and how costly they will be and etc. That's one of the channels. Financial requirements, again, investments, cash, scalability of this business model, right? Business model might be good but not scalable. Business model might be scalable but bad. What you need is a good scalable business model, and which actually provides you with recurring revenue, high gross margins, and feasible exit strategy, right? So it should make sense from the point of view of either next investors or better potential acquirers or public markets if you want to make an IPO. And to sum it up, there is, on every stage, you should monitor different things. So you actually have to monitor both financial metrics and business milestones, so operating things. And in pre-revenue early stage companies, what you have to monitor, first of all, is operating expenses and cash burn. Cash burn is an aggregate number, which will help you to understand when to raise another fund or round of financing. Operating expenses, you have to track the efficiency, potentially the efficiency of those users. And you have to monitor how the product is being developed. And this is strongly connected with OpEx, right? Especially in technology, programmers, coders, and additions to team. Who do you add to the team to increase its first its value and its effectiveness? If you have already early revenues, you of course have to keep tracking of OpEx and cash burn, but of course revenue. You have to dig deeper, understand how this revenue is being produced, how repetitive it is. Is it the same clients who is given to you or new clients, and etc. etc. And in business milestones sections, you have additional things to track. Is the product itself, its metrics, right? You have to track how people accept that, what should be changed, what should be added, what should be deleted from the product, how it's being developed, tech-wise, money-wise, people-wise, What is the customer's feedback? Very important. Team, of course, and sales pipeline. Because you already have revenue, you have to project that and understand your cash burn, future cash burn, and something to actually to show as attraction to new investors. If the company is close to profitability, interestingly enough, I have two same words here. You should track in financial metrics revenue, OPEX and cash, but gross margin already here, right? You have to track this gross margin to finally understand how to become profitable. So if in early revenue stage you actually track the top line, here you track already midline and trying to see when you will be positive on bottom line, positive potentially into the future. And of course, sales pipeline, like bookings of your products and services. Team, of course, HR questions are all over this place. They just go through all the pieces and all this table. And marketing plan, how you will be selling more. So actually, it's connected with sales pipeline. It's just some things to track. Just again, financials and operational milestones depends on the stage of the business, but you need to track more with the project moving towards growth and maturity. That was it in terms of VC investment process. Things. If you have questions, please don't hesitate to ask. I hope it is more or less clear. But next topic is something we for sure need to cover today. It's basics of a startup, and we will first of all it's capitalization table. So I will proceed, but don't hesitate to interrupt me, stop anytime, ask questions for the previous section or this new one. So basics, actually, what is cap table? Cap table is a list of all your company's securities, which was issued. It's stocks, warrants, equity grants, options, and as well as the names of the companies and people owning them. This cap table actually is keep track of who owns how much of your company. Usually it is being held as a spreadsheet in Excel. It's not very efficient, but still that was how it was mainly. There are special software products currently which actually help you to track the cap table of your startup. Actually, this spreadsheet cap table is its representation of all the transactions that have taken place since the company inception. So actually, on every financing round, there were a list of investments with particular terms, and all goes into this cap table. And in reality, actually, cap table is made up of many transactions and legal documents. They differ from round to round, and they build up over time. And it's becoming more and more complex. There is no single document which actually takes us all together. But here below are the few examples, right? It's the documents of stock issues. That's the sales, that's the transfer of stocks, that's the cancellation of particular stocks or options, that's some conversions of debt instruments into equity instruments, that's the track of exercising the options, usually by the team when you have an option pool, that's the vesting of those options pool, right? Once you exercise the option on the stock, it doesn't mean you get all the stocks initially 100%. It usually have cliff vesting. Let's say you have 25% of your stocks according to your option, and then you get additional 25% of your stock every year. So actually, once you exercise the option, you need still work for 3 years into the company to get the 100% exposure to the stocks. This motivates people to stay into the company. So in the end of the day, this capitalization table management, it's all about legal claims to the assets of the company, right? And through the capital structure. It is important to understand the differences among different shares, right? Different shares are being used. First of all. Second, you have to understand that there are issued and there are outstanding shares. Number of issued shares that are still outstanding, this is something to check. This includes actually exercised options and warrants, but they exclude unexercised portion of that. Doesn't include shares that are forfeited to some legal things, cancelled, they repurchased by the company, or otherwise not longer outstanding. So just from corporate finance, remember, company can approve particular amount of shares, part of them only might be issued, right? And others be understood. Fully diluted shares means that you have to take into account all potential shares, both issued and outstanding. This is actually the number of potential shares the company has contractually agreed to issue via warrant and option agreements. So they are not, these warrants and options have not yet been exercised. Once they will be exercised, the company will have to issue these additional shares. And the fully diluted number already shows you that should this happen, the number will be this one. In other words, this is the number of potential shares set aside in the company's equity plan that have not yet been contractually assigned. So they are waiting to be sold, functionally. There are authorized shares. That's the number of shares that a corporation is legally allowed to issue. So let's say you have 1 million authorized shares. It means you cannot issue additional shares to this number. To make this, you have to change article of incorporation of your company. And it takes some corporate actions, right? Of the company. You need to take your shareholders, you need to vote to get this voting, etc. If the company has multiple share classes, which is very often for different series A, B, C, D, often different share classes are being issued. The article of incorporation will also specify the authorized number of each share class, right? And this AOI can be amended anytime by the board to increase the numbers. The logic of dilution, what is dilution? As the company grows, as far as I understand, key founders will dilute themselves. They will share the equity stake in the company with first employees through option pool and with investors, which provide capital in each round. It can be tricky after raising capital via convertible notes or preferred stocks. In this case, equity ownership is no longer a function of number of shares the founders own. We will see during our course some interesting things here. You will get the flavor of that, but just a key takeaway for you from here, not everything that easy as it might be. Venture investments actually often has additional economic right assigned to shares issued into the round, and these additional economic rights can additionally dilute founders and as a consequence change the amount of cash founders get upon the exit, and these things actually depends on different milestones and the agreements. The sources of dilution, first of all, is new shares from equity investments. So you are making another financing round, investors are coming, they're paying money, you're giving them shares. The shares of previous investors dilute naturally. New shares can be issued as a part of equity compensation plan for the team. That's then all the investors being diluted, but they have to agree with that. Interesting things happens when you convert notes, which actually so-called debt financing, but initial idea of conversion, convertible notes is just don't have a valuation around, don't have a talk around valuation. So if we like each other as a company and investor, and everything is fine except valuation, we say, okay, let's have a deal. We have a conversion note and we will see what the valuation of the company is, I don't know, on the next valuation round. And I, as an investor through the notes, will get some discount to that. And that will be the third party valuation we will use in our calculations, and that's fine. There might be some valuation caps, so it might have some floors. And of course, there should be a discount because I put money earlier than next investor. But we will talk about conversion notes later on. Very interesting. And there might be also anti-dilution provisions of preferred stocks, and they work shortly the following. I invested today into the company, and I agreed if the next round will be with down valuation, I should get some additional stocks, because otherwise it's not very fair. So that's in a nutshell. Some dilution patterns which I promised you to show today. So employees dilute quite quickly as far as you get in terms of common stock ownership. They have all the company at first. Then with first round of financing, you see they have on median 73%, which means that they gave away 27. Remember, this number is more or less was shown at the start of the lecture. On the next Series A round, additional 13% are being given away. And for Series B round, as far as you remember, when most of the companies are being sold to tech companies, the founders altogether are no longer the majority shareholders of the company. And the share is decreasing with each series of financing, but with less and less steepness. And the 15% option pool to motivate the team is more or less typical. It includes both issued and unissued options by stage. So issued, which means that you have already motivated, it's part of your team exercised and partially vested, and you still have unissued stocks. So more or less, that's close to 15. Interesting enough, that founders' wealth actually doesn't top after Series B and later on. So actually, the valuation, no, it's different. The average founder is becoming wealthier with each series, but the median, which actually separates those who get lower wealth and higher wealth, is stuck after Series B rounds, right? And the reason here is this dilution. So not every company is increasingly go up in valuation, but the dilution is happening, right? So in a nutshell, taking also into account the preference of one class shares in front of another class shares. Remember, the earlier investment is, the lower it's in the capital stack. The valuations, the wealth of the founders might be somewhere here. And it's naturally now, right, that they sell companies on this stage. Because to get more wealth with more financing is not that obvious now. And maybe another skill set is needed. And the company, you lose control. You have new people, more management style coming into the company, changing the process, and etc. So that's quite natural for entrepreneurs to give away company here, or at least not devote enough time here, and maybe start something else. That's okay. So outstanding startups continue to increase in value, and here founders keep becoming wealthier. Let's say Zuckerberg, and I don't remember the founder of NVIDIA. He has still huge stake into the company. That's the exceptions, right? This is the cap table, the simplest one. Again, this is the picture from the book, the first book recommended to you, required actually to read. And we have two blocks here, pre-financing and post-financing. So the idea, number of shares is 10 million in pre-financing, and as far as you see, 5 additional million shares is being issued into the Series A round, and this is the line for investors in that round. And what we see, the number of shares for previous investors who are founders and employees here is not changing, but their percentage ownership is actually changing, because the total number of shares has increased. So the share of the previous investors and founders actually decreases proportionately. You can see it. I hope you see it, but I will try to maybe show you. This is as far as you get. it was 0. Now it's 1/3 of the company capital stock. So all number of shares, it's always 100%. These numbers didn't change, but you have new shares issued to Series A investors. Is it? I hope it's clear, guys. Is it clear, or more comments are needed? Okay, I continue. Interrupt me if there's a question. And let's talk a little bit about price per share. There is an original price per share. This is the price per share which you pay for each price per share here. Look, with this 5 million new shares should be paid with particular amount of money. So you divide this particular amount of money by this 5 million, you get the price of one share. This is the original price which you paid for your share. The aggregate purchase price, that's the price in US dollars or in money, right? It's paid for all shares of the security issue. So actually APP equals OPP multiplied by the shares. And APP is actually the investment with only one type of security. It's more difficult with several security types. Again, while you will be reading the book, you will get some ideas of that. But just for you to remember, initially you purchase the stocks. Each stock has particular price. You pay APP for the whole chunk of these new shares. But then with additional investors, all the conversions and things like that, things become more and more complicated. And let's look at the simple capitalization table now. Let's suppose we just have started the company. We have two founders, and these founders has already put part of they have already formed the option pool with common stocks, right? And there is no valuation yet. We just have signed the papers. We established the company. On a fully diluted basis, founders have 40% each, and 20% is an option pool on a fully diluted basis. Remember, which includes option pool, so actually future shares which are not issued yet, right? So on a pre-diluted basis, it will be 50-50. So two founders decided to start the company 50-50. But in documents, they already have some option pool agreements potential, which they will use to hire people. They will say, look, you will have small salary, but look, you will have option. If the company will be successful, you will become rich. And some people agree. Now let's look at the situation when we have first angel investor. This is independent angel who decided to invest. And he decided to invest 200,000. And the pre-money valuation, I will show you in a couple of minutes the basic equation for that. But okay, he decided to put 200K. They agreed with the founders that the company should be valued 1 million before this investment. So it means 1 million to 1.2 million after. And the angel is getting the shares into the round, 500,000 shares. So the total number of shares outstanding increasing, right? It was 2,500,000. It's now 3 million shares. And on a fully diluted basis, let's see the following picture. Founders has been diluted, right? We still have an option pool. Each share has also diluted, right? So on a total aggregate basis, angel has got 1/6 of the company, right? 1/6 of the company is still assigned to the option pool, and 2/6 of the company has been attributed to each of the founders. Altogether, 100% of capital stock. And we might have another angel going into the next round. Interesting enough, but let's say he's getting another chunk of stocks. This time it might be preferred stocks, but the idea is the following: on a fully diluted basis, previous investors, including option pool, are being diluted. So the new investor got the share in the company. The number of shares of previous investors stays the same, but their capital stack in terms of percentage share is decreasing. And then we have VC round and etc. I will not stop a lot on that at the moment. We will come back to this later, or you will look yourself this weekend, I hope. And we might consider exiting the valuation, right? So let's go here directly. So let's say there was a VC round and we consider different exit projections, right? It's like 15 million, $30 million, and $45 million. We have the fully diluted stock percentage here. And it means that this exit valuation will be split according to the fully diluted stock percentage ownership. And you will have to calculate the return on each investment for different investors: first angel, second angel, first VC round, and etc. So which means that actually the founders will get 2.5 million each in case the exit valuation is 15 million, and etc. And now let's deep slightly more into the basics of the startup, which is pre-money and post-money valuation. It's a very important concept. It's easy one, but it's important. So actually the post-money valuation of the startup, it's the pre-money valuation plus investment. In other words, it's just the next second when investments is done, it's just the cash going into the company, right? So actually pre-money valuation, that's the valuation of the business without new money. You put new money in and you get the post-money valuation, right? That's simple. It's like with corporate finance, right? You have equity value of the company, which is EV plus net debt, yes, which might be negative, of course. So the proportionate ownership of venture fund or investor which has invested is easily calculated by dividing I by post-money valuation. So actually, if you have a pre-money valuation of the company, I will show you here. Okay, the price per share is the pre-money valuation divided by the number of shares being outstanding. How it works? Look, we are given, we are investing 1 million into the company which we agreed on valuation about, which it is 3 million pre-money valuation. And we know that the new shares, 1 million new shares, before this round, 1 million shares was already issued. So we have unknowns and let's calculate them. The post-money valuation, the share of us as investor into this startup, and the price of the share we pay. So the initial price, remember OPP, original purchase price. The post-money valuation is easily, it's pre-money valuation plus investment. So what we do, we take 3 million, which is the valuation of the business we agreed on, plus new money. So the post-money valuation of the business is now 4 million. What is the venture capital share in this case? We have invested 1 million. That's our stake. And the total valuation of the enterprise after our investments is 4. So effectively, we actually have 25% into the company after we have invested, right? And it's easy to calculate the price. We know that before the round, 1 million shares was in place. And before the round, the valuation of the business was 3 million. This is how we agree, right? We agreed that it is 3 million valuation and it should be split equally among 1 million shares. So each share at this stage worth $3. I will stop here. I will pause to wait for your questions if you have them. Please don't hesitate. It's a very important concept. A lot will be attached to this idea, and
I need to make sure that you understand this. Okay, I assume it's clear, but please ask even in chat. I will show several pictures just for you to get the flavor. The global median deal size, for different stages of investments. The deal size, that's the E here, then money invested in. So for angel and seed investments, like previously, before 2018-19, the median size of the investment was below 1 million. For early stage VC investments, which is Series A and B mostly, that was 2 to 4 million. It is, as far as you see, it is highly increased. Even in 2019, if we get this from the previous year, it's interesting to see that's the KPMG yearly, even quarterly report. You can easily find yourself. And for late stage investments, the valuations has also increased, but not so high. The deal size by series is here. So the previous one was an aggregated one. Here we have the split by each series, seed, A, B, and etc. It's clear that series B was increasing faster. And even series D, which is very late stage pre-IPO things, was increasing even at least more steadily through the last years. If we look at the pre-money valuations of the businesses without new money coming in, you see that for early stage, that was fine to have a valuation even 8 years ago, 3-4 million. And for early stage Series A, that was already more than 10 million 7 years ago, and already 22 years ago, 22, and etc. For late stage investments, the valuation skyrocketed again for late, very late stage D plus series. So big, large, I would say, private companies, pre-IPO rounds, that was skyrocketing. Now, many of them then made IPO during the last couple of years and appeared as a public companies. Not all were successful, but still many of them were noticeable. If you look at the global distribution of rounds, most of the rounds usually up. So usually the valuation of the startup goes up with each round, which is normal situation, normal case. But the situation can be flat, or you might even have down rounds. And as far as you see, it's more than 10%, right? It varies from somewhere in between 10 and 20 historically. So now let's slightly talk about the entrepreneur's role. It will be easier pictures for you now. So first of all, entrepreneurship, it actually bridges the gap. It bridges the gap between the technology opportunity and the value. So actually entrepreneurs are those who are trying to extract value from technology or business model or opportunity or niche, etc. There are 3 key resources which are being used by the entrepreneurs. It's actually technology itself, it's people, and it's money, right? So venture capitalists provide money. Sometimes they help with people, and what they want the technology to work, right? They want to make sure. There are 3 key mechanisms of these things. It's actually mobility of technology itself, mobility of money, and interestingly enough, mobility of people. Mobility of technology. Transfer of technology is coming from research institutions to commercial applications. We touched upon that in the first lecture. So there are 2 actually ways of transfer. It's formal through licensing and IP rights, buying IP rights, and it's informal through people, right? So technology at the start is still people's ideas. So you might find right people, buy them out, take them into your company, then make patent or IP right, and that will be the process. People themselves, they are professional entrepreneurial management teams, right?
They have their own lifestyle. They like personal mobilities. There are multiple employers. They work for multiple employers. They like equity compensation instead of fixed compensations, and they are fine with some failure. They're not afraid of that. Um, and there is also mobile money. It's actually new forms of private equity. As far as we see during the last years, international investments are being done more and more by the US venture capital firms. So actually, in the last 5 years, the activity of US venture firms globally has increased a lot. Multinational corporations become more active. Remember, corporate venture capital, and as far as I remember, the growth was quite noticeable in the last several years. It's either every fifth dollar or every fifth deal in the market, which actually involves corporate capital already, corporate venture capital already. Interestingly enough, that buyout funds becoming more active in this earlier stage. For them, it's earlier stage. For venture, it's later stage. It's a growth stage. It's somewhere they overlap. And actually, angel communities are becoming more sophisticated. They invent different ways of how to collect money, how to spread the risks, how to make the processes of investment, etc. Interestingly enough, you have to understand the startup logic versus the mature company logic. And look, from us as people working in particular company, the consequences are very much different. So for mature company, if you work there, it's either bonus or promotion, or at least you have some flat salary, right? In startup situation, it's life or death, because either your startup will succeed, and almost probably it will die. It's actually life and death. In terms of commitment, in mature company, you mostly commit professionally, right? You still have your personal life, or people like talk about work and life balance, and etc. In startup, it's almost unrealistic. Usually, you have total commitment, personal, professional, everything. In terms of culture, in mature companies, there is more routine, more brands, less personal, right? More formal, and etc. In startups, it's quite intense, unified. It's very much personal, and it's team-based. It's all about teams, chemistry, and people. No routine, because you need to be fast, adaptable. If you try to take processes from mature company to the startup, startup will die. In terms of coordination, in startup, because you have small or medium-sized teams, it's more or less informal and intuitive. In mature companies, which are usually of larger size, it's more programmed, it's more managed. There are more measurement, KPIs, and etc. So the spectrum, this is the spectrum, and you should understand that most companies somewhere in between, but startups closer to the left, early stage are to the most left part of that. In terms of compensation, it's interesting enough that in mature company, your compensation with time increases, usually slightly, if you have a good career. But in startup, it might be flat for a long period of times, but then it suddenly skyrockets. It's when your options actually plays out, right? And if you look at how the value is being created in company, it's created in steps, right? First, it's created with time and in steps. It's all about technology, product, they evolve. It's all about marketing, their successfulness, and it's all about management of those efforts. If we look deeply, so actually in terms of technology value creation, first of all, it's concept, right? If there is a prototype, the valuation of the total enterprise of the total startup goes up. In case you are successful in patent application and you have IP right, it goes up. If then your prototype is working, it goes up again. On every step, the value is being created, and this value is actually perceived by investors and the market. If you then start manufacturing those prototypes in small series, it goes up. If you have regulatory approval, then of course it has to go up. And if the market takes your product, it goes up again. So it goes in steps. Steps might change in sequence, but this is the idea. It's not appearing at once, right? It appears in steps, and it's adding market value. It's all about adding market value. You have to make analysis, you have to make focus groups. What you're trying to do, you go to the market, you try your concept testing, you make a beta test, and you launch it into the market. If you have satisfied customers, it's good, right? It's a positive feedback. It's one of the checkbox into the investment process. And then it goes up in steps. It's just for you to get the flavor of the situation. And there is also the line of management value. So it starts with chief technologist, then it might be president. We add people from marketing. Then we need somebody to control the cash uses and make OPEX efficient. If we start manufacturing something, we need somebody who's responsible for that. Once we manufacture it, we need somebody to sell, so we hire sales managers, right? Once we have revenue and we need to calculate all those metrics and numbers, we need chief financial officer who will be making reporting, who will be calculating profitability. And since our company is growing, we need to hire human resources manager who will be managing this part of the business. So it's all about different pieces. It all goes in steps. You as a CEO, I'm sorry, of the company, you have to put it all together, and it's difficult processes. And VC funds and angels will help with this. It's interesting enough that the founders, their so-called founders dilemma, I want you to tell a little bit about that. And it's the following. It's the most entrepreneurs, they want to make a lot of money, but still they want to run the show. They want to be the king, right? They want to have the control in the company. And interestingly enough, it's difficult to do both things. You have to choose. Founders have to choose either or. And if they don't figure out which matters more to them, they actually risk losing everything. They might be neither rich nor the king. This is that's from Harvard Business Review paper. And on the left side, we have the level of control, and on the horizontal, we have the financial gains, potential financial gains. So actually, there are failure bucket, rich bucket, exception bucket, and king bucket. What is king bucket? It's the full control of the company, but the financial gains will be below the potential, right? Because you will not accept new money from new investors on the step when you lose control. So the growth of your company will be less than potential. Interestingly enough, that if you have already lost control, but you are still well below potential, that's the particular failure, right? Close to potential, left to the right bucket. It means that you have lost your control, but you're fine with growing the business with losing control, right? So the company usually becomes much more valuable. Yes, you have less stake in that. You are not in the control of all the processes, but you become rich still because the company's valuation much more. There is an exception that the company is still hitting the milestones and the founder still keeps control. At least operational control, right? Not only in terms of number of shares, but remember in States, for instance, there are different types of stocks. There are stocks which actually give you more votes than others. And that's an exception. And Mark Zuckerberg and the founder of NVIDIA actually are good examples here, as well as Jeff Bezos in Amazon to some degree. So first of all, choosing money, founder gives up more equity to attract investors. He builds a more valuable company, and he ends up with more valuable slice of that company. There is a founder who will choose control. They're motivated by these control things. They might be control freaks at all. They will make decisions that actually enable them to lead the business at the expense of increasing value. That's very important. So there are people like that. Psychological patterns are quite important. And when you invest, when you choose the projects, this is something in the bucket of the team just to keep in mind. Sooner or later, investors will insist that founders give away the control of the startup. That's natural. First of all, with every next round, founder is being diluted, and sometime in the future he should lose control. Usually after 2, 3 rounds of financing. And the interesting situation that CEO or founder might be fired, even fired, if majority of investors decide so. If they think that this people is not more very suitable, not more suitable for the company. When the founder has delivered results, he need a change as the top becomes greater. Right? The situation here is that success actually makes founders less qualified to lead the company. There might be exceptions, but usually, once the company has grown to a particular point in time and increased in number of people and processes, another skill set is needed. Other people should come to the company for sure. And from time to time, it means to change the whole management team, including founder and CEO. And founders often might make decisions that conflict with wealth maximization principles, right? Again, some founders are motivated and drive to create and lead organization rather than become wealthy. In this case, it's difficult to expect a huge increase in valuation. And the problem is that entrepreneurs, they become emotionally attached to their companies, right? And this might create problems for the company in the future. And interestingly enough, most of the founders, they resist the idea leaving from CEO position because for them it's harder to accept less important roles. And they are overconfident about their prospects and about problems they will face. Interestingly enough, that how venture capitalists deal with that, they put draconian discount rates on valuation. Right? It's one of the mitigants you can use to decrease your risk, just to decrease the valuation of data when you buy the company. Again, here is the king, here is the rich person, and that's psychological patterns. The outcome is following. Founders who actually desire control should restrict themselves to business where they have needed skill set and contacts, and where large amounts of capital are not required. So actually asset-light businesses, less capital-intensive businesses, this is the areas where more control-free founders might be successful. And maybe they also should wait late until their careers before making a startup, because in this situation, they have developed broader skill set, savings, and experience, which will allow them to run the company for longer with success. Founders who actually want to become wealthy should be open to any ideas that might require resources. They easily will lose control, but that's not a problem for them. Interesting enough, what will be the situation? That's an interesting picture. I like that one. Actually, the telephone might be calling, but it's important call, but not enough to hire additional staff to talk to you. And as far as you guess, the reason is no additional money was attracted from potential venture investors because founder should have lose control at this stage. So actually, not enough people into the company. They are unable to answer the clients in time. So some statistics on startup. This is from CB Insights, one of the sources I mentioned to you. So actually there are several rounds, and what they did, they actually take the initial cohort of seed capital raised in 2009, 10, and 11, and they analyzed the statistics. And interestingly enough, that after the second round, which was only two-thirds of the companies, right? So 1/3 of the company have not attracted the capital. Then of those on the second round, 1/4 hasn't raised. So dead rounds included. And several companies, like 13%, which is 71 companies, made an exit already, early stage. On the next round, again, sufficient amount of company haven't raised the capital. That was already 13%, and 10% made an exit. And then you goes on and on. Interestingly enough, that Mega exit is really small fraction of already at that time successful seed investment, right? Because not every company, not every idea, not every startup raise even seed round. So that's for you to get the flavor of that. All those successful unicorns, mega exits, that's only the small fraction. Again, remember the power law, right? That's how it works. A couple of more things before we finish today. That's top 20 reasons startup fail, and usually that's the case. It's based on the analysis of 101 startup postmortems. It's again by CB Insights, interesting resource. I highly recommend to use that if you are interested into the sector. From time to time, you will find interesting materials and analysis of particular companies. First of all, no market need for the product or service. That's the most important reason. So actually, remember the question, does the client of the service or product exist not in mind of the founder, but in reality? And is it a must-have product or a nice-have product? These things are very much connected with this first reason. Second one is run out of cash. You have to manage cash carefully and raise rounds in advance and actually calculate the effectiveness, see where the money goes out, what are the uses of money, and not the right team is the third one. So almost every fourth company actually mentioned that's a problem. So actually, market need, cash burn, and the right team, right, and a lot of other as well. And interesting picture, the role of the venture capital in the life of a startup. As far as I remember, it was from another source. Okay, but anyway, that was for sure true. Here you see that 81% of startups actually answered that they would probably not have survived or developed very slowly in case if they have not attracted the venture investment. So they say that that was valuable not only in terms of money, but in terms of experience and other value add from the industry, right? And once they were asked in terms of what particular value you've got from venture investors, they answered the following. So different types of financial advice. Again, it's highly correlated with the second reason of startup fail when they run out of cash. So some things in terms of financial advising is very important. VC help with corporate strategy. They see the market, they understand the ins and outs in that. They helps with networking and also new ideas, and etc. and etc. And of course, the fifth one is contacts at market information, and sometimes even recruitment of management people, and etc. So that was helpful. And we have maybe a couple of minutes. I will ask you a question. Please answer as you think fastly and not in chat. What is the business of the most successful company? How do you think? Just whatever you have on your mind. Okay, you are on mute. Okay, okay, again, chat, I see. Tech. Not exactly, but most of them, yeah, this is a nice picture, actually. What we see here is that these 5 companies actually have the revenue streams of the big tech. Yeah, we have tech here. Most of them, except of Microsoft, actually have the most of their revenue from one service or product. But interestingly enough, with time they develop. Look at Apple. First of all, Microsoft is the oldest here, right? And it has the diverse set of income streams now already. If you look at Amazon, which is also quite old company, right? And Apple and Alphabet, they are diverse in their income streams, right? Facebook at the time of making this picture was mostly based on ads. But what do they have in common? What do you think? Okay, let's move on. Maybe you will get that. Their platform or so-called ecosystems in there. I found interesting white paper on global platform survey, and it's the Center for Global Enterprises. It's 5 year old, already 6 old soon, but still, you see that globally, even 5 years ago already, there were a lot of platforms in different regions. Most of them, interested in us, was already in Asia. And as far as you know, technology in Asia, especially in China, actually is outperforming American companies in many things. In terms of market cap, America was still the largest number, but in terms of employee hired. But what is interesting enough, here you can have a nice picture of these platforms, right? They can be transaction platforms, which you see on the left. And here you have most private companies, innovation platforms, which are already integrated and they are changing some particular markets. They adjusting to the trends. It's Microsoft, one of them, Intel, interesting enough, Salesforce also. The platforms might be integrated, right, like Facebook, Alibaba, Amazon, and they might be also investment platforms, which we have SoftBank, Naspers, it's a South African company, and etc. Interestingly enough, the platform comes, yes, mostly in San Francisco, Seattle, but in the third, next from, you see that number 3, 4, and 5 cities, that's the Chinese city. Beijing. Yeah, that's the problem. Country, it should be China, not US. They were mistaken. That was the split. But for you, just to show you some interesting things, the platforms might be asset heavy or asset light, or they might be mixed, right? And in terms of asset heavy, you see that 5 years ago, look, 5 years ago, that was Daimler, General Electric, Johnson Controls, companies which actually become trying to grow their platforms or ecosystems, right? What are the companies, automotive companies are doing? They are putting more and more technology into their products, and they try to make an ecosystem around that. Right, we have asset light platforms like Google, Uber, Priceline, etc., and we have mixed companies like Apple, which and etc. You can find the newest one maybe in the web, but just for you to know some things, that the largest companies, most of them, largest successful companies, most of whom have been venture financed, they actually have platforms on ecosystems. I have two people in chat. Opportunity cost. Their products are used every day. Yeah, Victor, that's true. Again, that's about something we have mentioned today. The stickiness of the client and the habits. Have these products and services change the habits? If people start using something and use it every day, their habits has been changed by this product. Zoom, we're using Zoom now. Zoom, it's interesting. It's actually, I will try to find information on Zoom for you. That was an interesting example. How the company became so successful. They say once the people start using verbs like to Google, means Google never will disappear. Now people use let's Zoom, which means Zoom most probably will not disappear. The valuation is a question, but still the product is already highly accepted by the market. Okay, I think it's enough for today. We haven't covered some numbers. But no problem, we will cover it later on next time. It's not a big deal, but still for you just to have. I think next time we will have a short test. It will wait a little bit into the total mark, and so please tell your colleagues about that. I will send today, this weekend for sure. Today I will try to send you today this presentation and the link to the book. I think you have to start reading. Most of you have not done that. And I will try to finalize this Google Classroom, which I promised. The problem is my wife put somewhere the book with the password. I couldn't find that, but I will do that for sure. That's all from my side. If you have questions now, please kindly ask. If not, then see you next time. You're welcome, Roman. Okay, bye bye. Have a great weekend.